Chapter. I'm a program director at Toronto Centre. I'm also leading Toronto Centre's recently established community of practice on financial inclusion and gender equality. If you would like to join our group, please send me an email. Today, we are hosting Leora Clapper as part of our community of practice event. Today's theme is measuring financial inclusion and the Fintech revolution. We will have a Q&A session after the presentation. You will have a chance to ask your questions about her presentation. I hope you will enjoy the webinar. Now it's my pleasure to introduce you our guest speaker, Ms. Leora Clapper. Leora is a lead economist in the finance and private sector research team of the Development Research Group at the World Bank. Her publications focus on corporate and household finance, banking, and risk management. Her current research studies the impact of digital financial services, especially for women. She is a founder of the Global Fintech database, which measures how adults around the world save, borrow, make payments, and manage risks. Before joining the World Bank, she was with the Board of Governors of the Federal Reserve System. She holds a PhD in financial economics from New York University's Stern School of Business. Leora, thank you very much for joining us today to share your knowledge and experience. Over to you.
Thank you. It's really a pleasure to speak with your group, especially around the links between financial inclusion and stability, with a bit of an emphasis on how the gender gap in financial inclusion can be addressed by policymakers, regulators, practitioners, and researchers. So first, just the definition of financial inclusion by the World Bank, that households have access to and can use appropriate financial services, highlighting the importance of these services being provided responsibly and sustainably in a well-regulated environment. We define an account as an account at a bank, at a other non-bank financial institution, or mobile money provider that can be used to store money and to send and receive electronic payments. And you can link financial inclusion and financial stability in three important ways. One, it can help increase income, helping poor people invest in education and business opportunities, pull themselves out of poverty. Second, by increasing resilience, as important having savings in the bank, access to appropriate insurance products, and help people survive those that have a bread earner, an illness, a natural disaster, and by increasing transparency. Digital payments are easier to track, and this is important to understand in regards to anti-money laundering, anti-terrorist financing, as well as understanding in real time economic activity. And so there's a long growing list of literature, academic rigorous literature, showing the importance of even just offering an account to poorer adults, especially for women. Here are just two highlighted examples. There's been work looking at the impact of providing financial services to rural farmers in India. They found poverty fell about 16 percentage points. There's been more recent work looking at the impact of mobile phone services in Kenya, and it showed a tremendous impact on helping lift adults out of poverty, especially women-headed households. There's also an important role for electronic payments. This is really a preview of my presentation. We're going to talk about both access to financial services as well as usage, not only to make payments, but also to receive payments. So for example, in Niger, when the government shifted from paying out cash to paying government transfer recipients directly into their own accounts, they found that the government saved a lot of money. The government also found a reduction in leakage. Intended recipients were more likely to receive their money, reduced reduction in costs and time of dispersing cash. And from the perspective of the recipients, not having to travel to the city and garnish wages to stand in line to receive their payments, to reduce security risk of walking around with a lot of cash in their pockets, they monetize it equal to a day's spending on food. And so let me just also, working a little backwards from the global Fintech data, to look at one specific question we asked around financial resilience. We asked the question globally: do you come up with about 1/20th of GDP per capita in the next month? So let's say there was an emergency, a health emergency, you needed that money. Could you come up with it? Only about 3/4 of adults in high-income countries, and about half of adults in developing economies said it would even be possible. And then we can start looking at we asked them, what would be your source of financing? And so, first it was important to highlight a gender gap. Women were less likely to say they could come up with the money. Poor adults were over 25 percentage points less likely to say they can come up with the money. Countries like Brazil, Colombia, Kenya, Peru, women are about 20% less likely than men to be able to raise the money. And when we start looking at the sources of financing, and here just looking at these bars on the left, we find that the majority of adults say, I would either depend on my family and friends, or I would just use informal sources of borrowing or informal sources of savings. And this is really going to highlight the work we're going to talk about. That in the case of emergency, so first of all, borrowing from family and friends isn't free money. When if you're asking friends to bail you out, you regularly have to bail them out. And you can't save for your own goals. Secondly, what we're going to talk about is most savings around the world is kept in unsafe ways. In Pakistan, for example, over 20% of adults say if I had an emergency, I would use my savings. But 18 of that 20 percentage points are adults saving under the mattress, where the money may not be when that emergency hits. And so this is really our motivation, our introduction to why we believe access and use of formal financial services is so important to help build stability and reduce fragility of the poor adults around the world. So just to put this in a little context, the global Fintech data, 10 years ago, there was growing interest in household finance, but we didn't have much data. My colleagues at the World Bank and IMF have been collecting data directly from regulators around the world, what we call supply side data on a number of accounts, which they collect directly from banks. But we were frustrated. It's sort of a black box of data. I wanted to know how many men had accounts compared to women, how many poor adults had accounts as compared to rich adults. We certainly didn't know at the time, for example, that in Turkey, for example, men are more than 30 percentage points more likely than women to have an account. In the Philippines, poor adults are more than 35 percentage points less likely than wealthier adults to have an account, and so on. And so with funding from the Bill and Melinda Gates Foundation and collaboration with Gallup, we started collecting this data on a global scale. And so here's our headline map. We're delighted that the headline figure on account ownership is now Sustainable Development Goal 8.10, recognized by the United Nations as important to achieve our development goals. As an aside, I have we wrote a compendium of with the Better Than Cash Alliance, showing how financial inclusion can help enable each development goal: water, electricity, gender, economic empowerment, etc. So the third edition of the Global Fintech data in 2017 has shown that almost 1.2 billion adults have gotten an account since 2011. It includes about 515 million since 2014. Between 2014 and 2017, we see that overall about 69% of adults around the world have an account. In developing countries, we see about 63% of adults. We see this one very, very large caveat, that about 300 million of those 500 million accounts were opened in India, where the government, leveraging the biometric Aadhaar ID number, simply rolled through the country for opening accounts for everyone. They slashed their gender gap from 20 percentage points to 6 percentage points. They were able to give accounts to poor adults, to women, to rural adults. In India today, about over 80% of adults have an account, which is on par with China, with Brazil, with Malaysia. We also see a darkening of the map in Central Asia, where, for example, the government committed to digitizing their own accounts. We also see a darkening of the map in West Africa as mobile money accounts. So these are accounts offered by telecoms that, in addition, their mobile agent network, in addition to selling time and minutes on your phone, are now providing financial services. This provides often a more affordable, convenient financial services in the people's own village. Throughout Africa, for example, most villages don't have an ATM or bank branch, but increasingly every village has a mobile agent to provide those local services. These are often more important for women who, either because of social norms or family responsibilities, might find it harder to travel to the city to access banking services, can now do so locally. I'll tell you a story from Ghana, for example, where we saw in our data in 2014 that 30% of women had bank accounts but reported using really expensive, sort of unsafe ways of saving. They're using these susu collectors who came every day to their home to pick up $1. And then they gave it back to them at the end of the month, less than $1 savings, which is expensive, right? And so we went and asked them, why are you doing this? And they said, well, the banks, I need to save $1 a day outside my home, or my husband or some other family member might take it. And bank accounts aren't designed for those sort of high frequency, low denomination payments, so savings. I'm not going to take a bus every day across town to wait online to deposit $1. What was exciting was in 2017, if you look at Ghana, where we see about a 30 percentage point increase in account ownership, these same women are now saving at the merchant mobile agents next door to them on their block, much more conveniently affordable. So mobile money accounts are designed for these sort of high frequency, low denomination payments. It both as a way of saving, but also as a way of sending money, perhaps safer and cheaper and more easily among both P2P as well as to businesses. And so here, just to highlight, in Africa, we find now that 21% of adults across the region are using mobile money accounts. And you really see this darkening of them out in West Africa and beyond. It's really important to notice two remaining very light blue spots on the map of Africa, which are Nigeria and Ethiopia, which in 2017 had not allowed regulation did not allow for mobile money agents. In both countries, there's a hope that recent reforms will expand access to financial services. And I think it's an important note that mobile money accounts often play an especially important role in conflict areas where it's more dangerous and less secure to travel with cash. Mobile payments, digital payments, is a way of relaxing those constraints. For example, following the Ebola crisis, digital payments were used to pay health workers, which enabled them to stay on the job at a time when it was dangerous and risky to transport cash around the country. Okay, so just one more slide on bigger picture. We see here, this is the relationship between account ownership and economic development. As you look globally, there's a strong positive relationship. As countries get richer, account ownership does go up. But let's hone in on the countries that have the below average GDP per capita, so the bottom half of the world in terms of economic development. Here we see absolutely no relationship, correlations around 0.17. And what we see here is, it's almost a vertical line. You have countries around the 80% mark with the same GDP as countries with around the 20% mark. And so what's going on? So certainly regulations matter. I mentioned Nigeria, Ethiopia, two examples of countries which at least in 2017 had weaker Fintech laws, or the regulations which did not enable mobile money banking. That certainly held back those two countries on the African continent. We also see some good, we see some positive steps. If you look at the very top, that one dotted about 94%, is Mongolia, where the government makes regular monthly payments into accounts, a form of a natural resource gift, benefits. And there you see adults not only having accounts, but also using their accounts. We also see countries, which we'll talk about in a few moments, which have, for example, in Ghana, where the government committed to digitizing their own wage payments to all government workers. We saw an increase in account ownership. And then some of the smaller cases is where we start seeing the non-inclusive growth of account ownership. And so the punchline I hope for you to come away with is that countries cannot achieve their financial inclusion goals without inclusive growth in account ownership. So for example, we find in many Middle East, North African countries, young adults, 20 percentage points less likely than older adults to have an account. We see in many regions where less educated adults are less likely to have an account. This sort of highlights the importance when designing strategies to expand financial inclusion to make sure that people have the financial capability to use the account. When you're working with adults who might be illiterate, innumerate, it's a lot harder to provide financial services, especially via mobile phones, which often only operate in English, or might require, for example, memorizing a 10-digit PIN number. It's important also to provide that financial, to ensure financial health, that adults know how to use their accounts safely, everything from keeping their PIN number private to recourse in the case of error. And then we certainly have regions with large gender gaps and large income gaps. I just want to just take a second to show that this is not only exclusively in developing countries. In the United States, for example, poor adults are more than 13 percentage points less likely than wealthier adults. Those living in the bottom 40% of households are 13 percentage points less likely to have an account than those living in the top 60% of households. And now let's talk more specifically about the gender gap. As I mentioned, India slashed their gender gap. We also see in Indonesia, there's never been a gap. There's been inclusive growth, and now about half of all men and women have an account. But the gender gap has been stuck at 9 percentage points in developing countries since 2011. We haven't made any progress. And that's because in many countries, we're actually seeing a widening of the gap. And this was really upsetting to see when we started getting the data in 2017 and trying to figure out what was going on. As I mentioned, Turkey is an example. Men are more than 30 percentage points more likely than women to have an account. Accounts are costly. About 70% of women are out of the labor force who may not have the immediate need for an account. But then we see other countries where the gap has been growing. Take Pakistan, Bangladesh, Morocco. These are countries where the government has committed to financial inclusion strategies to increase account ownership. And they have seen an increase in account ownership for men, but less so for women. In Pakistan, men are more than 4 times as likely as women to have an account. In Bangladesh, for example, we had a surge in account ownership, over 30 percentage point increase in account ownership for men, but only about 6 percentage points for women. Bangladesh is an example of where the growth is coming from mobile money accounts. But here we're leaving women behind. As I'll show you in the next slide, women are less likely to own a mobile phone. There are also cultural norms. Are there women agents? There's probably not. And just cultural norms just make it difficult. Women hesitant to give their phone number to a strange man, which is necessary to activate to use your mobile money account. The most popular product is English-based in a country where over half of all women are illiterate, have a long PIN number, and just very challenging. So whereas mobile money adoption for men has surged, hasn't been the case for women. And so let's talk for a second, who are the unbanked? The beauty of demand-side data is that this is a nationally representative survey on the individual level, which allows us to look at who doesn't have an account. So globally, it's still somewhat of a numbers game, although India, as I mentioned, made tremendous progress. India, China are all around about 80% account ownership. In terms of numbers, we still see the largest numbers of unbanked, as well as Mexico, Nigeria, Pakistan, Indonesia, and Bangladesh. We start looking at who are the unbanked. Over half are women. In some countries, much higher, like Algeria, Morocco, and Bangladesh. About half live in the poorest 40% of households. In China, over 65% of the remaining unbanked are poor adults. Again, stressing the need to design financial products for the poorest adults who may have the greatest challenges managing their money. About over 60% have only a primary education. In Cambodia, that's 95%. Again, stressing the importance when designing financial products to make sure that you also build in the financial capability. And about half are out of the labor force. And this is important because, again, as we're reaching the last mile in delivering financial services, we need to understand how it's harder to design these products for people without regular income streams. And so we also asked the question of, among them banks, why don't you have an account? So about 60% of adults say, I don't have enough money. But multiple answers are permitted. And only about 20% of adults say only reasons. So my hunch is that if banking services were more affordable and convenient, more people may report having the money to use one. And it's really important to recognize that only 3% of adults, unbanked adults globally, say they don't have an account simply because they don't need it. This is suggesting a huge untapped demand for financial services around the world. About a quarter of the unbanked adults cite accounts being expensive. That number is almost twice as high in some Latin American countries. Mexico, where account ownership has been relatively flat over the past 4 years. We're in a more concentrated banking sector. That half of all adults cite costs. Important to note, Mexico has recently passed the first fintech law in the world. It'll be exciting to see how the industry progresses there. About a quarter of unbanked adults cite a family member, or I use somebody else's account. In Turkey, as I mentioned, with the enormous gender gap, this is a response more often given by women. I use somebody else's account. And let me just pause to highlight the importance for a woman to have her own account. I'm often asked the question, even by my own colleagues, you know, bank accounts are expensive. It's a luxury good. Why isn't it enough to let the male household head have the account, let other members of the household use it? And there's a growing academic literature that just offering a woman an account gives her greater privacy, control, and security over her money. It gives women a more comfortable seat at the table, greater say over household spending and budget decisions. There's the work in Kenya, Nepal, Sri Lanka, the Philippines, all consistently showing that offering a woman an account increases household spending on education, on healthcare, and nutritious food. Offering women business owners an account increases their investments and their profits in Kenya. Offering insurance products to women in Malawi increases their yield. In the Philippines, there's a great study that offering an account to women increases the household's purchases of washing machines and goods that may be more valuable to women. And so overall, the goal is to provide every adult with a safe place to keep his or her own money. And so about a quarter of adults, adults say the bank's simply too far away. And here it's important to note, again, that about 60% of those saying banks are too far away report owning their own mobile phone. So how can we leverage the technology? How can we leverage those mobile agents in the village to provide for affordable and convenient financial services? So one inside unbanked adult site, I don't have the right document. In 2017, we added a question to Fintech, do you have a national ID with the name, for example, do you have an Aadhaar number in India? And we found that around the world, most adults do have ID, with the exception of West Africa, where not only is ID ownership relatively low, but we see big gender gaps. And so, for example, a quarter of unbanked adults in sub-Saharan Africa report documentation as a barrier, including over 40% of unbanked adults in Togo. And here's a country where the gender gap in ID ownership, men are 17 percentage points more likely than women to have an ID. And so throughout the region, to bridge the financial inclusion gap, we also need inclusive ID ownership. And finally, we see about 15% of unbanked in developing countries citing trust as a barrier, although this number is twice as high in ECA in Eastern Europe and Central Asia and LAC, especially in many of the post-communist countries, where, and this has been, quite a while, the government's either appropriated money from banks or allowed the private sector to appropriate the money. Really, we see that memories are long following banking crises and bank appropriations, and it's really important. It takes a long time to rebuild that trust, which is why it's so important to ensure a stable financial system. Just to mention, we also asked if religion was a reason. This was simply not highly cited, even in the Middle East and North Africa. So we have new data in 2017. This is actually hot off the press data from 2018. I have a related blog last week on Brookings on mobile technology and digital inclusion. Here's looking for some select countries on mobile phone ownership. Gallup includes the question, do you personally own a mobile phone? So we see about globally, about 86% of men, about 79% of women have a mobile phone. That gap is much larger in some other countries. Here, the length of the bar are, the gray are men who have a phone, the blue bar are women who report owning their own phone. At the end of the bar, the number indicates significant gender gap. I mean, Pakistan has a 58%, men are 58 percentage points more likely than women to have their own phone. Bangladesh, Egypt, India, Nigeria, Vietnam, additional countries where we see this gap. And again, as we are increasingly leveraging mobile technologies to deliver financial services and other government services, it's important that we don't leave women behind. one interesting correlate with phone ownership is ID ownership. In 2017, we added the question around the ID ownership. If you have an ID, why did you use your ID? For government payments, a government service, a financial service, a mobile service. And really, to my surprise, far and away, the most common reason mentioned for using an ID was to purchase a mobile phone. And that's because there are today AML, CFT, know your customer requirements to purchase a phone. And interestingly, as an aside, many countries have relaxed KYC to open a bank account, but don't have those exemptions to purchase a phone. And so in Pakistan, for example, we see this enormous gender gap. I apologize, the circle should be around Pakistan. That 86% of men have an ID compared to 72% of women. So again, holistically, in order to have financial inclusion, narrow the gender gap in financial inclusion, we also need to think about ID inclusion and digital inclusion. So how do people use their accounts? Let's just talk, we'll start with saving. Let's talk about why we care about usage of accounts. And this is that because about a quarter of accounts in developing countries are inactive. We define that as they haven't made a single deposit or withdrawal in the past year. And so remember all those new accounts in India? About half of all accounts in India are inactive. As the government introduced these no fee, no minimum balance accounts, India won the Guinness Book of World Records for opening the most bank accounts in a single month. However, they've not yet a use case for these accounts. And so I'm sort of the optimist. I see this as the world's biggest financial inclusion opportunity. Going forward, how can we design appropriate financial products so people can use these accounts to improve their lives? And so as we just discussed, here's one more slide in this, the importance of fintech to expand financial services. This map is showing the size of the bubble are the number of unbanked who also own a mobile phone. And so we're getting big numbers. So not only for the first time we can tell you, not only that there are 1.2 billion unbanked adults around the world, but that there are almost 1 billion unbanked adults who have their own phone. So let's talk about saving. About a quarter of adults save at a formal financial institution. About 55% of adults in high income report putting aside money in the past year into a formal bank account. Close to 20% in developing countries. You see only about 16% of adults saving for old age in the past year. In sub-Saharan Africa, where people have fewer other forms of resilience, they're less likely to have a pension or private insurance, less likely to be able to depend on the government in many countries to help them in case of emergency. Savings is very high, but formal savings is very low. For the most part, people save under the mattress or in livestock or in gold. About a quarter of adults in sub-Saharan Africa report saving using a community savings group. And so these have tremendous benefits in that they're community, they're social, it's a form of social insurance. However, they're also often unsafe. Someone in Nigeria told us she belongs to 4 community savings groups because she expects the first 3 to steal her money. It also, having that formal banking relationship establishes a relationship that can lead to access to other formal financial products. You think about credit. In developed countries often relying on physical collateral, using your house, for example, as collateral. In countries where people don't have that physical collateral, lending is based on reputational collateral, on your payment history, on your savings history. Moving savings from community savings group, perhaps maintaining the social aspect of moving that money into a bank can help people develop the relationship with the bank so that they can have appropriate credit when an emergency hits. And so this is just the map of sub-Saharan Africa. The blue showing relatively low formal savings rates versus the orange of very high semi-formal savings rates. So again, these are people who are able and willing to save on a regular basis, but doing so outside the formal financial system. And we estimate there are about 160 million banked adults in developing countries who are only saving semi-formally, who aren't taking advantage of their accounts. I mean, perhaps the story I started with in Ghana, it's just not convenient. The banks may not be designed for a regular, small, low denomination, high frequency savings. But increasingly, mobile agents are working as agents on behalf of banks and other agent networks facilitating this formal savings. And so just to talk about some opportunities, we also see this as an opportunity. So for example, in Pakistan, about 9 million unbanked women are saving regularly in the community savings group, about a quarter of the unbanked women in Indonesia, and overall about 35 million unbanked adults in sub-Saharan Africa. We also look at borrowing. Punchline is simply that informal borrowing is the predominant form of credit around in developing countries, with the exception of some higher middle income countries like Brazil, China, Turkey, where even credit card debt is taking off. And in sub-Saharan Africa, we see more the use of the semi-formal borrowing, so borrowing from the same community savings group where they're saving. And again, this is talk about the gender gap is not exclusive to developing economies. We also have the question on, do you have a loan outstanding for the purchase of a home or land? This is around the world. And we see, for example, in Italy, men are more than twice as likely as women to have a housing loan in their own name. In Saudi Arabia, men are more than 4 times as likely as women. Also, let me pause. So in 2014, we also added questions funded by S&P on financial literacy. We added a series of questions around people's understanding of inflation, of interest rate discounting, of inflation, discounting, interest rate compounding, and discounting. I'm sorry, 2 questions around interest rate compounding. Effectively, we found that only 1 in 3 adults worldwide were able to correctly answer 3 of the 4 topics. But even more specifically, looking at people who reported having a formal loan outstanding. So people who borrowed from a financial institution or used their credit card in the past year, over half of those adults emerging in, these are the BRIC countries in Brazil, Russia, India, and China, and South Africa, were unable to answer a basic question on compound interest. And almost a third of adults in high-income economies, in the G7 economies, were unable to answer a basic question on interest compounding. So for example, credit card ownership in China doubled between 2011 and 2014. Then over 40% of adults, credit card owners in China, were able to answer a basic question on interest compounding, highlighting the importance of both financial education, but also the risk of too quickly extending credit in developing countries while understanding is lagging behind. So finally, let's talk about digital payments. When you think about a Venn diagram of how people use their accounts, far and away the most common use of an account is to send or receive electronic payments. Between 2014 and 2017, the share of owners, and this includes swiping a debit card, making a payment from your account using a mobile phone or over the internet, using your account to receive a wage payment, a pension payment, a payment for the sale of agricultural products, or using your account to pay a utility bill, a gas, electric, or water bill. And so, or to send or receive a domestic remittance payment. And so in developing economies, we find about 70% of account holders making or receiving a electronic payment. In some economies, we saw a surge between 2014 and 2017, such as in China and Thailand, where there's over almost 30 percentage point growth. Just some examples. I think this would be the most helpful way of summarizing where we've seen a surge in the use of digital payments. And just a little bit of indication of what was driving this increase. So Bangladesh, where I mentioned the surge in mobile money ownership, although again being an example where women potentially were left behind. Georgia, where the government digitized their own payments, and we saw a large increase. Jordan, where, so again, government wages were digitized. Kyrgyz Republic, where people able to pay their electricity bills electronically. And let me highlight, this is far more than just a convenience. Being able to pay a utility bill electronically allows, we know that online payments is related to on-time payment. This encourages investment by the utility company. It also enables the development of all sorts of creative pay-as-you-go models, which has rapidly expanded access to electrical services, electricity in Africa. Mongolia, there's been an increase in debit cards, online utility bills, in Sri Lanka as well. Thailand, we saw a big surge in the POS, point of sale network, and Venezuela, which certainly is not an example to emulate, but as cash disappeared from the economy, the only way people were able to buy subsistence goods was by using a card or by using their phone. We saw a surge in the use of debit cards, and perhaps suggesting the importance of digital payments as a form of resilience. And also just a sort of an interesting question we asked on online shopping. And so we asked this question, I sort of naively asked the question, have you made a payment over the phone, using your phone or internet, and calling that online shopping? However, it's not. We went and piloted these questions in Vietnam, for example. I asked, how did you make the payment? They said, well, we pay in cash on delivery. And so building the trust in the system to enable online shopping is hard. The suppliers have to believe they'll be paid. The buyers have to have confidence that they'll receive their goods. And this is really important, and this is important development for the ecosystem. Enabling online shopping increases the market opportunities for sellers and potentially reduces the cost of purchases for buyers. In China, where the WeChat, Alipay digital payment systems were developed for the purpose of online shopping, over 85% of online shoppers paid online. However, on average, only 7% did. In Vietnam, for example, over almost 20% of adults shop online, but only about 3% actually pay online. And as you can see on the right, there are tremendous market opportunities to develop this ecosystem. So now we get into some opportunities. But the Fintech data can also literally quantify what are the size of the opportunities to reach the unbanked by digitizing payments. And so certainly governments often ask, what can we do? How can governments take the lead? Well, certainly the first step is by digitizing their own payments. It's not as easy as just deciding tomorrow to send the money to the banks to make electronic payments. There needs to be the ecosystem. There has to be the liquidity available on payday, for example, for people to cash out their money. Even better yet, the ecosystem for people to spend their money electronically at merchants using their phone or a card to keep the money, so people can keep their money safely on their phone, which also potentially help them manage their money better over the month. And so in high-income countries, about 40% of adults receive a government payment, only about 20% of developing economies. This includes wages, pensions, and transfer payments. The figure on the right, the blue are payments made directly to an account. But yet the orange are those still made in cash. And there's still tremendous opportunities. This is a map where the dot is the size of in millions of adults who still receive payments in cash. Philippines, over 7 million unbanked adults receive government payments in cash. In Ethiopia as well, they're big opportunities. So next, let me talk for a moment about digitizing of private wage payments. So this is a photo that I took in Bangladesh, where a lot of my research is focused on supply chains. And so the opportunities of the large buyers who often sit in the G7 countries to use their influence through their buyer network to improve sustainable standards, to improve the lives of the workers. And we believe increasingly that well-designed electronic wage payments can improve the workers' lives. In the study in Bangladesh, we did a horse race, like a drug trial, where workers continue to be paid. We tracked workers who would continue to be paid in cash as compared to workers paid directly into their own accounts. And as the workers said after a few months, my mother-in-law waited outside the gate for me on payday, now she can't. And the workers, especially the women, very quickly realized that they could keep some savings in the bank and have a more comfortable seat at the table, determining how that money was spent. After 18 months, we found that women paid into an account as compared to cash. Their savings more than doubled. They sent less money home to be saved by family members and saved more themselves in Dhaka. They were less likely to buy gold and other assets and keeping their money in savings in the bank. And they also reported a greater shock resilience and greater control over household spending. So looking at some opportunities, about 230 million unbanked adults globally in private sector jobs who are paid in cash. Of course, many of these jobs are in the informal sector, but a lot of them are in global value chains. It's also interesting how the Gap and Levi is committing to requiring their buyers to pay their workers electronically by 2020, or start risking losing their contract. Is giving urgency to this agenda of developing this ecosystem for electronic payments in order to maintain the supply chain relations. In Indonesia, for example, nearly 30 million unbanked adults are paid in cash. The additional challenge there, of course, is the islands, the remote areas. Many of the factories are in areas which simply don't have as much liquidity on payday at the bank. And so it's, again, building up that ecosystem, the merchant payment system, their own phone, which offers additional opportunities. Finally, agricultural payments, another area where I've been working. And so think of the agribusiness, and again, we ask the question, do you receive income from the sale of agricultural products? Certainly some might be informal sellers, but increasingly these sellers are selling towards into global value chains, think cocoa, tea, coffee, wheat, etc. On average, about 1 in 5 adults receive agricultural payments, already report receiving them into an account. There are almost 280 million banked adults globally, people who already have bank accounts, many of whom live in India, who are still receiving their payments in cash. This is a tremendous use case. In India alone, 65 million banked adults receive their payments in cash. And let's think again, farmers are often workers, adults are the most in need for formal financial services. They may get paid only once after the harvest. They need to stretch that money to the next harvest to finance their seed financing, purchase insurance. They need to buy food daily, pay monthly school fees, all while managing their money. And these are all tools that formal financial services could help provide. And I think it's a really important proof of concept. Look at the bar on the right, where in Uganda, Kenya, and Tanzania, about 20% of all adults in those countries are farmers being paid directly into their mobile bank accounts for the sale of agricultural products. And certainly, I'm sure much of that money is cashed out for immediate necessity goods, but increasingly farmers are additional products are being cross-sold to allow those farmers to save that money for the next harvest, to collateralize the purchase of seeds and other input financing. And so I'm actually working, setting up a large project right now in Sri Lanka with tea pluckers. Again, these are primarily women who pluck tea and help them. What's interesting about tea and perhaps many other agricultural chains is the amount that they pluck is weighed daily using Bluetooth-enabled scales, which means that there is electronic records of their daily earnings, which potentially could facilitate salary advances and other financial products which can help them build resilience in a less expensive way. And so globally, there are about 235 million unbanked adults who receive agricultural payments in cash. Again, about 60% of whom have a mobile phone. Vietnam and Nigeria, 2 examples with large opportunities. And finally, we ask the question of how do you pay your utility bills? Again, we believe this is far more than a convenience. In just China, India alone, there are over 500 million adults still paying in cash. Digitizing those payments not only would allow, we know that especially women often garnish wages the day after payday to run around town paying their bills, but also enables pay-as-you-go utilities. I was recently teaching in a regulators class, a class of regulators from around the world, and a woman from Zambia was excitingly explaining how she personally, her electricity is more reliable and dependable because of a new investment in a pay-as-you-go model, which is depending on that digital payment infrastructure. And so my key takeaways for you today, financial inclusion is on the rise. Digital technology is enabling the growth of financial services. However, women and poor adults are still less likely to have an account. The gap in access to technology and ID is also large in some countries. However, leveraging digital financial services, this is digital payments and adding on savings, credit, insurance products, delivered through digital platforms. We didn't talk much about today, but certainly setting up a large project right now in Sri Lanka with tea pluckers. Again, these are primarily women who pluck tea and help them. What's interesting about tea and perhaps many other agricultural chains is the amount that they pluck is weighed daily using Bluetooth-enabled scales, which means that there is electronic records of their daily earnings, which potentially could facilitate salary advances and other financial products which can help them build resilience in a less expensive way. And so globally, there are about 235 million unbanked adults who receive agricultural payments in cash. Again, about 60% of whom have a mobile phone. Vietnam and Nigeria, 2 examples with large opportunities. And finally, we asked the question of how do you pay your utility bills? Again, we believe this is far more than a convenience. In just China, India alone, there are over 500 million adults still paying in cash. Digitizing those payments not only would allow, we know that especially women often garnish wages the day after payday to run around town paying their bills, but also enables pay-as-you-go utilities. I was recently teaching in a regulators class, a class of regulators from around the world, and a woman from Zambia was excitingly explaining how she personally, her electricity is more reliable and dependable because of a new investment in a pay-as-you-go model, which is depending on that digital payment infrastructure. And so my key takeaways for you today: financial inclusion is on the rise. Digital technology is enabling the growth of financial services. However, women and poor adults are still less likely to have an account. The gap in access to technology and ID is also large in some countries. However, leveraging digital financial services, this is digital payments and adding on savings, credit, insurance products, delivered through digital platforms. We didn't talk much about today, but certainly there are enormous risks being presented by digital credit and other credit products. This must be supported by an appropriate regulatory and consumer protection framework, are the keys to achieving inclusive financial inclusion. And so the global Fintech data is all available online. You can download it, aggregated on the country level, or we have all 150,000 observations online for you to download. Every figure I showed you today is from our report, and we have online the data for all 150 countries for every figure, so you can pull for your own countries. And if you have a moment, please enjoy our videos, which are available in English, Arabic, French, and Spanish. So thank you, and I'd be delighted to answer any questions. Hello. Hi.
Hi. You received the questions via email from us, so we collected all the questions. You may proceed. Let us know if you didn't receive yet.
I'm sorry.
Okay.
Let me put that
That's fine. So those are the list of questions.
Okay. Here. Okay, so the question, I received one question on the policies in India that help them narrow the financial inclusion gap. So India was able to leverage the biometric identification, which is, approximately 900 million people have an Aadhaar number, a digital ID, which enabled them to, using agents, go throughout the country offering, they required all banks to offer a no fee, no deposit, no minimum balance account. Certainly this was enabled by the fact that the largest banks in India are nationalized banks, and was greatly successful. But as I mentioned, we can't yet rule India. So, because both women, poor adults had identification, they were able to open accounts for all adults and narrow their gap. However, as I mentioned, still about half of all accounts are inactive, haven't been used for even one deposit or withdrawal in the past year. And it's important to mention also that the gender gap in active accounts is still quite large in India. So men are about 12 percentage points more likely than women to have an active account. And so they still have ways to go to encourage women to use their accounts in India. And then the second question, no, exactly. So the second question asks, why is there a widening of the gender gap? There's a number of these countries where we see the widening gap have committed to national financial inclusion strategies. And I think this really just highlights that these countries have shown that these strategies are working, that there's been an increase, a surge in account ownership in some of these countries, but only for men. And so we have in our report, a figure showing a dozen countries where over half of all men have accounts, but only the women's account ownership is in the 20s or single, or teens. And that because of that gap, the countries will never reach their goals. And so I hope the message is that when designing financial inclusion strategies, it's important to include in the strategy specifically how to reach and how to design products for women to meet the women's financial sector needs, service needs. Are there any other questions? Oh, I'm sorry. I see some other question. Sorry, there's one more question in the chat. So someone has a very good question. Does FinTech promote financial inclusion, or is it the other way around? So, and I guess here we're thinking about, maybe we could look carefully at access versus usage. Certainly, potentially FinTech is important for access to accounts. In the case of West Africa, for example, where mobile money accounts has led to the surge in account ownership. But if you look at the case of India, for example, I think the promise of FinTech is to increase now the usage of accounts. People have accounts, but if it's inconvenient and costly to use it, they're not going to. If you have to take a bus to a branch to stand online to talk to a teller, you're not going to use your account. If you have to use a debit card, but you don't know how to use it, or you're not comfortable using them, no one's ever showed you how to use the machine, you don't trust the ATM and you can't remember your PIN number, you're not going to use your account in a safe, responsible way. And here's where FinTech does offer opportunities to access financial services using the phone in your own home, using an agent who potentially you're comfortable with, someone in your community. And so FinTech offers tremendous opportunities also to increase usage of accounts. Are there any other questions?
Thank you, Laura. I think that's all we had so far in terms of questions. Thank you very much for your presentation. It was quite insightful. And I just wanted to let everyone know that we will be posting this webinar on our website next week, probably, and we'll share the link with all the participants. Thanks again.
Thank you very much, Smith.
Thank you, everyone. Bye.
Have a nice day.
Bye.
Bye.
I believe there were more questions.